Hello, welcome to our new video series on IFRS 9 for corporates. I'm Sandra Thompson. I lead our global accounting technical function for financial instruments, and I'm very pleased to be here today with Nitassha Somai. Nitassha is currently in my team on secondment from South Africa, where she helps our clients there. IFRS 9 is a new financial instrument standard, and in this series of short videos, we aim to give you an insight as to what it will mean for corporates and what you should look out for. There's an old adage that time flies when you're having fun. Well, when it comes to IFRS 9, time certainly seems to have flown. The standard was actually issued back in 2014, but its mandatory effective date of 2018 is now fast approaching. There's a common knowledge that IFRS 9 will have significant impacts for financial institutions like banks. But what about corporates? I think a lot of people feel it might not have much impact. Well, in this video series, we aim to show you why we think that perception is wrong, and also to highlight what the main impacts should be. We aim to give you some practical tips about how you can go about both identifying issues and implementing the standard. And our overall aim is to make sure you know what to do now, and so you can avoid nasty last-minute surprises. So Nitassha, at a very high level, can you tell us what IFRS 9 requires?
IFRS 9 is split into three distinct categories, firstly being classification and measurement. So what do I measure at amortized cost and what do I measure at fair value? The second part is impairment. Something you might be familiar with is your bad debt provisions. And then lastly, hedging. As hedging will have the most significant impact for corporates, we will start off with that first. So Sandra, I hear hedging for corporates has a lot of benefits under IFRS 9. Can you tell us a bit more about that?
Thanks, Nitassha. Yes, hedge accounting requirements are generally good news for corporates. So I'm certainly familiar with corporates that enter into hedges that look perfectly good economic hedges, but they struggle to get hedge accounting today. Under IFRS 9, some of those barriers to hedge accounting will be removed, and generally IFRS 9 will bring hedge accounting more in line with how management actually manages risk.
So Sandra, if you had to pick the top three benefits for corporates, what would it be?
Oh, my first one would definitely be hedge effectiveness testing. So under IAS 39, there's a requirement that a hedge is 80 to 125 effective. It meets that bright line. Under IFRS 9, that bright line's removed, so hedges that are slightly less effective can still get hedge accounting. The second one I'd pick would be hedging components of non-financial items. I'll give you an example. Suppose an airline wants to hedge its future purchases of jet fuel, and it does that by buying a crude oil derivative. Today it may well not be able to get hedge accounting, whereas under IFRS 9 it can designate the hedge as being the crude oil component of its jet fuel and get hedge accounting. And the third one I picked would be hedging with options and forwards. Today that gives quite a lot of P&L volatility. Under IFRS 9, some of that P&L volatility will be removed, and it could make hedging with options and with forwards more attractive.
So we've heard the good news to applying the hedging requirements. Are there any pitfalls?
Well, I'm afraid there are. I'm afraid some of the requirements are quite complex to apply. In particular, if you hedge with options or forwards, then actually measuring effectiveness can be quite a lot more difficult, and that may imply some systems changes. And secondly, because the rules for hedge accounting are changing, all hedge documentation will need to be updated. So even if the basic hedging strategy doesn't change, and even if a company gets hedge accounting under IAS 13 and IFRS 9, it will need to update all its hedge documentation, and obviously that's going to involve some work. Nitassha, you mentioned two other parts of IFRS 9. Can you tell us a bit about classification and measurement?
The classification rules under IFRS 9 has changed significantly since IAS 39, especially on your financial asset debt investments, so things like your trade receivables, intragroup loans, as well as on your financial asset equity investments. There are some changes on financial liabilities as well, and we'll touch on that in a bit. However, I guess for corporates, the impact is not as significant as it would be for hedge accounting.
Thanks. So what would be your top three issues in this area?
I think starting with financial liabilities, so where corporates restructure their borrowings, the gains or losses arising from that restructure needs to go through profit or loss. Another key area is where corporates factor receivables as an example. Some of these receivables could be measured at fair value through profit or loss under IFRS 9. And then lastly, Corporates that hold shares in companies will no longer be able to apply the cost exemption when measuring the value of those shares. It has to apply fair value, even though this might be difficult to do. So in particular, where investments are held in unlisted entities, it might be difficult to get a fair value, but there is no exemption any longer.
Thanks very much, Nitassha. The last area you mentioned up front was impairment. Can you tell us a bit about that, please?
Impairment has definitely been one area of the standard that has changed significantly as we move from an incurred loss model to an expected loss model. So what does this mean? Well, under an incurred loss model, we waited for something to happen before we booked an impairment loss, whereas under the expected loss model, we book an impairment loss almost immediately. There's additional complexities because the standard requires you to take forward-looking information into account as well as past experience, and incorporating this information is not the simplest thing to do.
Thanks. So continuing our theme, what will be your top 3 tips for corporates when it comes to impairment?
So I think bigger provisions will definitely come about as a result of the new impairment requirements, together with more volatility in the income statement. So this might be very relevant where you have long-term receivables or long-term intragroup loans. Another important consideration is for things like trade receivables, where there might be a double hit to the income statement on day one. So for example, the new revenue standard might require you to discount the receivable on day one, and at the same time you would need to book an impairment loss under IFRS 9, so you can see that there will be a double hit on day one. And the last message is simpler might not be better. So IFRS 9 does have some operational simplifications for corporates, which might be easier to do. But this may result in bigger or more volatile provisions in the income statement. So you would need to weigh up the benefit of applying a simpler model with more volatility in the income statement versus a more complex model with reduced volatility. Again, we will cover these in the videos to come.
Thanks, Nitassha. So as I hope you can see, IFRS 9 will impact corporates as well as financial institutions. There are a number of issues and the impact can be big. In our future videos, we'll go into more detail on each of the areas we've covered today. I do hope you'll join us next time. If you'd like to subscribe for the whole series, please click on the subscribe button at the bottom of your screen. Bye-bye.